Your 401k has been open for over a decade. You've contributed to it every single paycheck, and there's a real chance it's still working against you. The problem could be where that money is sitting. If you're over 40 and you've gone conservative with your investments because you already made one mistake and can't afford another, this video is for you. By the end of it, you'll know exactly why that instinct is quietly costing you the recovery you're trying to make and what a real catch-up allocation looks like instead. Because every year you stay too cautious between now and retirement is a year you don't get back. And at this stage, you have fewer of them left to waste. Two men turn 42 this year. Both finally start taking their retirement account seriously for the first time in their working lives. Dave puts almost all of it into a target date fund weighted heavy toward bonds. Ben puts most of his into stocks. Dave tells his wife he's not doing anything risky this time. Ben tells his wife that he doesn't have the years left to be cautious. He's already been burned once. Maybe it was 2008. Maybe it was a stock he held too long, or a business that didn't work out. Whatever it was, it taught him a lesson. Don't lose money you can't get back. So when he finally starts investing again in his 40s, he does the responsible thing. He plays it safe. That instinct costs him decades of growth he no longer has time to make up. At 25, a portfolio has close to 40 years to ride out a downturn. A bad year barely registers by retirement. At 45, that runway is roughly half as long, and a conservative, bond-heavy allocation trades away the one thing a shorter runway actually needs: growth. The Federal Reserve's own data on historical asset returns shows equities have outperformed bonds by a wide margin over every rolling 20-year period on record. That decision guarantees his money grows too slowly to matter. 20 years later, Ben's balance has done the compounding work Dave's couldn't. Dave's hasn't lost money. It just never had the chance to become enough. The years available to fix a mistake are running out. That's what makes the cautious move the dangerous one. Ask Dave why he chose bonds, and he won't say returns. He'll say something closer to, "I already made one mistake. I'm not making another." That sentence is fear wearing discipline's clothes. So, if you're the guy who already made one financial mistake and has been quietly protecting yourself from a second one ever since, hit like right now. It helps this video reach the next man doing the exact same thing without realizing it. And if you want more of this, the mistakes that don't feel like mistakes, subscribe, because that's the whole channel. Dave is protecting himself from a second version of the same shame, the feeling of watching a number drop and knowing it was his decision that put it there. The math never enters into it. What's driving the allocation is the memory of how it felt last time. Nobody corrects the misconception underneath that fear. Volatility and permanent loss aren't the same thing. But at 45, after one bad experience, they feel identical. A market drop feels like proof he shouldn't have tried again. It isn't. It's a normal temporary swing in an asset class that has recovered from every downturn in its history, given enough time to do it. His real mistake is mistaking a dip for a verdict. Run the two paths side by side for over 20 years. One stays conservative the whole way. One stays properly allocated for growth and rides out the swings without touching it. The gap between those two outcomes at retirement is the difference between a comfortable exit and working 5 more years than planned. Now, picture a third man. Call him Marcus. Marcus hears this exact argument, decides Dave's too cautious, and goes fully aggressive with no plan behind it. 6 months later, the market drops 15%. Marcus panics and sells everything, locking in the loss. He ends up worse off than Dave because being aggressive without structure exposes him to the wrong risk at the wrong moment. Fear made Dave too cautious. The same fear, with no framework to hold it steady, made Marcus reckless in the other direction. So before we get into what the right allocation actually looks like, telling someone to just be more aggressive doesn't give them a plan. It's worth being honest about what's really driving the conservative instinct in the first place. The real distrust driving Dave's decision is aimed at himself. Ben built a specific structure, then removed himself from the decision-making entirely. Telling a 45-year-old to take on more risk without a framework is how you get someone who goes aggressive for 6 months, panics during the first real drop, and sells at the worst possible moment, which is worse than staying conservative the whole time. Vague advice doesn't survive contact with a bad week in the market. Marcus is proof of that. What actually works looks like this. A growth-weighted allocation built around the specific number of years left until retirement, not a generic model built for someone starting at 25. Automatic contributions are set up so the decision to invest never depends on how confident he's feeling that month. And a realistic timeline for what catching up actually means, not doubling money overnight, but consistently capturing the growth rate a shorter runway requires, instead of the growth rate that feels comfortable. Compare Marcus's outcome to a fourth man. Tom, married to a woman named Karen, who started at the same point as Marcus, but automated his contributions and set his allocation once, with a rule not to touch it outside an annual review. Same market, same 15% drop. Tom's balance dipped on paper and kept contributing straight through it. 3 years later, the dip was gone, and the growth had kept compounding underneath it. Marcus was locked in a loss, chasing safety from his own panic. Tom never had to make that decision at all. The structure made it for him. None of this removes the years he already lost. Nothing does. What it does is stop him from losing the years he has left the same way. Dave is still safe. Ben is still catching up. Only one of them is actually going to close the gap. Say Dave doesn't change anything. Same bond-heavy allocation, same contributions, straight through to 65. Model it out, and the number comes in quietly smaller than he expects. A portfolio compounding at a bond-heavy rate for 20 more years lands meaningfully below the same contributions, compounding at an equity-weighted rate over that stretch, often the difference between retiring at 65 and needing to work into his late 60s to hit the same number. FDIC and Federal Reserve. Data on average household retirement balances by age show a shortfall this size between conservative and growth-oriented savers at the same income level. This shortfall doesn't show up until it's too late to fix cheaply. Dave keeps his job and his house. He just retires later into a smaller version of the retirement Ben gets on the same salary. Nothing dramatic has to go wrong for this outcome to happen. It's the default outcome of doing nothing differently. At this point, Dave's got a reasonable pushback. Isn't taking on more risk at 45 just reckless? Isn't that exactly the mistake he's trying to avoid? That reaction is a misread of what risk actually means at this stage. Real risk is the chance of being forced to sell at a loss because the money is needed before it's had time to recover. A properly structured allocation accounts for that, with a deliberate mix that shifts more conservatively as retirement gets closer, with enough growth exposure early to make up lost time before that shift happens. The actual reckless move is assuming caution is free. It never was. It's just a cost that shows up later, quieter and harder to reverse. Dave's real problem is what he's still quietly paying for, decades after he thought the decision was made. Because there's another decision men make in their 20s that doesn't show up as a mistake until their 40s, and it's not investing. It's the car sitting in the driveway. Check out this video next, where I break down how a car loan taken out at 25 quietly follows a man for the next 20 years, and what it actually costs him by the time he hits 45.